Hi guys, so I had a lot of questions about what's currently happening in the market and why. Now, I've been making my case for what's happening now over the course of the last 2 years. So I realize some people are new, and I'm going to actually be specific, very specific in this podcast, explaining you why, what, and how, because I realize not everybody is going to be able to go and rewatch last 300 videos that I have posted, preparing you for the moment that's happening in the markets right now. So the question is, why are we aligning this market moment right now with three major crashes? By the way, the three major crashes that I've been talking about for last 2 years now are 1973 crash, which is stagflation. Okay, so just write this down, okay? 1973 stagflation, and we're going to talk about each particular historic instance at a little bit more depth so you have better understanding. Okay, then you have market environment, 1985 all the way up to 1987, October 19th, 1987 crash, okay? And then you have 2007, 2008 transition, and notice I'm not mentioning the big crash, which is everybody. That's what most of the people are referencing. They're referencing the .com crash, and there is a reason why I'm not referencing the .com crash. So let's just get that out of the way. We're not going through a .com like bubble, because in .com bubble there were a lot of companies that didn't make shit. They didn't make any money. Now you have a lot of AI companies that are actually trading at valuations below that of Walmart and Costco. So this would be a ridiculous argument to compare AI, which is in a bubble for other reasons than valuations, and these companies are actually making fucking money. So in my opinion, it would be stupid, okay, to reference the .com bubble crash to the current market environment. Let's address what's really happening. Okay, the greatest market mispricing of the current market indexes and levels is the fact that the regular economy, like all the other companies, just think of it, there are two parts of the market. The old school, which is, all your regular companies, outside of AI. So think of any company that doesn't make goods or services associated with AI. And then you have a whole other sector of economy, which is the fastest growing part of the economy. It is the AI, or anything that's got to do with AI. I mean, and these companies within the AI sector, sure, some of them are young, but they're already turning a profit, okay? So those companies actually make sense to invest money in. But that's a common knowledge. So you're not going to make fucking money with common knowledge as a trader. So it's already been a known fact for the last 5 years. I mean, this AI boom's been continuing and continuing and continuing. And, it doesn't take a rocket scientist, to elaborate that, hey, this sector is the fastest growing sector in the economy. And it makes sense that, big funds, big money wants to invest in it. Okay? Well, if we look at it from the standpoint of that there's only that sector that's actually growing, and the rest of the economy, if we take out that sector, is actually not growing at all. More importantly, it is contracting, and more importantly, it's been contracting for a number of years. And more importantly, when you combine it with the economic reports, which we all know are fake, okay, but, they're fake in the way that they're being reported. Number one, they're not correct. Number two, a lot of these economic reports that they're issued, they are politically driven and motivated, so we never know what numbers are actual and what numbers are not. But if we study the businesses outside of AI, they're currently going from a recession into a depression kind of situation, okay? So it's like for whatever reason, the current market valuation is being presented as, well, the AI is going to save the entire world. My analysis are quite simple, okay? The AI is not going to save the entire world if 90% of the world is going through a recession and transitioning into a depression. That's also going to impact the AI companies that are so highly favored at the moment in the markets. The fact that 90% of the businesses are failing, the fact that there is a record number of bankruptcies, there's the fact that the old school economy is collapsing, okay, cannot be good for the one sector of the economy that is actually advancing higher. Okay, if 90% of the companies are fucking collapsing, it can't be good for the 10% of the companies that are doing good. Because by definition, you would want the 90% of the economy to be doing well, so the 10% of the AI companies could actually proceed with their fast growth expansion. And so that's what's mispriced. Okay, the current market valuations are mispricing the inaccuracy of all the economic data that we have been getting. If you look on company to company basis, it cannot simple add up. Like, speaking in simple mathematical terms, you cannot have every company in the United States, including, by the way, the AI companies, they're all laying off fucking people by thousands. That cannot add up to a positive job report, right? But we're not even going to concern ourselves any longer with validity of these job reports or economic data like CPI and all of what I'm going to tell you going forward from here. That shit is not even going to fucking matter. Okay? They can report good economic reports, shit is going to drop. They're going to report bad economic reports, shit is going to drop. And I'm telling you that the market has ignored all the bad economic data that has hit the tape in the last couple of years. It's not like the market is blind and they cannot do simple mathematics that, okay, well, they're reporting 180,000 jobs, but in reality, they're revising it a few months later to, 30,000 jobs. I mean, you cannot ignore simple mathematics, but yeah, that's what exactly the market's been doing. We've had job revisions on annual basis, close to 1 million jobs. So basically, that translates into every economic report being overstated by like 90%. And that's going with the data that they are giving us based off the revisions. So this is not the data I'm trying to speculate on and say, well, the data is total shit and it's inaccurate. I'm making that statement that 90% of the economic reports, okay, have been inaccurate based off the revisions data that they're giving us later. So every fucking economic report that we have been shown in which the market has gone higher has been inaccurate. And yet the market has been able to brush it off and move on higher as if nothing fucking happened when the accurate, or I wouldn't even call it accurate, I would call a more of an accurate data was revised and presented at a later time. The market didn't budge. And that shit's been going on now for multiple years. So at some point, okay, well, shit is, okay, it doesn't matter until it does fucking matter. But by the time it does fucking matter, okay, based on the context of the market, like it's been going higher and higher and higher, ignoring every bad piece of market data that normally would bring it down, you're in a moment where the market does not give a shit about the data. And that's what takes us to that moment in like 85 through 87, where the market continuously moves higher, 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 and was a lot of bad tape, a lot of bad data that was reported, and the market's been able to brush it off and move higher and move higher and move higher. So that's the similarity, right? That when we're talking about the three biggest crashes similarities, okay, that was the main similarity between 85 and 87 that led to the biggest one-day collapse in the markets and the current environment. And what makes it even more interesting is that October 19th was followed by nothing more, nothing less, by a Federal Reserve cut of a 1/4 point. So the last meeting before October 19th crash, for those that don't know, the market crashed close to 30% in one single trading session. And my argument is that's going to repeat over the course of the next 10, 12 trading sessions. It's not going to be October 19th, 2025, because the markets will be closed. It's Sunday, but it could be happening the night of Sunday through Monday transition. As you know, if you followed the channel for a while, you know we begin our trading day not on Monday, but we begin it on Sunday night at 6 p.m. when the futures open for trading. And I think the market is ultimately going to repeat exactly what it did in October 19th, which was a Black Monday in 1987. So we're going, based on this historic analog and based off these behavioral characteristics of the market, which are similar to that of 85 through 87. In my view, that's exactly what's been happening in the last couple of years, from 2023 until now, October 2025. So these behavioral patterns are a similarity that is pointing to what was transpiring in 85, 87 that led up to the one-day biggest collapse ever. Now, I've mentioned it on many occasions that oil is a good indication of what's really happening in the markets. And even like if you were in the group trading today, the first message I sent out this morning is I said, look, oil broke some key levels pre-market, 61.60, and the main comment I posted is I said, look, the rest of the market is going to follow oil. And so if you waited like maybe 40 minutes to an hour, the market began collapsing. So look at the oil chart, okay? Which oil, now based off all geopolitical reasons, technically should be trading much higher, but it's not. Based off the supply conditions, oil should be trading much lower, but it's not, because we got all this geopolitical shit that's happening. But oil is your canary in the gold mine, because if you study the collapse of 2007 and 2008, it is oil that makes the biggest drop. It's not the S&P, it's not the NASDAQ, it's not the Russell 2000, it's not gold, it's none of those things. Which, by the way, that wasn't an era that I said gold. Gold also was dropping in 2007, 2008. There are many instances in market history when the market indexes like S&P and NASDAQ drop, gold also drops. I don't believe this is the condition now because, as I mentioned, there's 3 market conditions, okay, that we're noticing are taking place now that are very similar to the 3 market crashes in the past. So the oil chart tells us it's 2007 and 2008 type market situation. The market behavioral pattern and market brushing off all the negative news is the condition that was met before the one-day collapse in 87. And the way gold is acting and behaving is telling us that we're in 1973, stagflation, because the only asset that outperforms everything in the 70s is gold. Gold goes 11x while the rest of the market collapses, goes sideways, and basically, for those of you that don't know, between 1973 and 1980, the market has not made another high. And so my argument is simple. The market is not going to make another high from here for at least another 3 to 7 years. And yet, you're going to hear people on public television, they're going to tell you it's a good idea to buy the fucking dip. Like, people don't even have a clue what a dip is going to look like when you refresh the charts 10 to 13 days from now. People don't have a clue how this dip is going to really look if you're going to refresh the charts 3-4 months from now, 12, 13 months from now. Because all these historic instances that I have just specified, 1973, 1987, and 2007, 2008 transition, okay, There's some wild fucking drops. Wild. Okay? And in instances of 1987, the market recovers pretty quickly. In instances 2007, 2008, the market does not recover quickly at all. And so is the case in 1973. So my point is simple, that since we have the market now that exhibits conditions and characteristics and setups of all three instances of some of the biggest crashes in history, that I wouldn't be betting on the fact that this market is going to recover quickly. Not to say that after initial crash, let's say of 20, 30%, we're not going to fucking bounce, maybe 10%. It's going to be a dead cat bounce, and we're going to go lower. But the point is, when the market drops sharply, you should be expecting bounces, and that gives you some entry points. For those of you that miss some good entry points, you wait for the bounce. That's when you short the market. I mean, we're officially in the biggest bear market the world has ever seen, guys. So hopefully this information helps you, okay? Stay on the right course of the market, okay? Go study on your own the crash of 1973, where the market drops 50% in 6 months. 1987, where the market drops in 1 day. Or if you combine the 3 days preceding to the Black Monday, I mean, it's combinedly 40-50%. You got 2007, 2008, where depending on which index you look at, the crash was between 50 and 80%. So with that information, we have a hybrid crash that just begun today on October 10th. And you haven't even really seen, as I mentioned earlier, you have seen a drop of blood in the bucket. I will be posting a video where the bucket full of blood of Wall Street is going to be filled. And that would be the time to buy the absolute bottom. But we're so we're miles and miles and miles away from that point. So forget about buying the dip. Forget about doing anything. Just focus on these three historic instances, three historic analogs that I just briefly explained to you. And if you stay the course, you don't want to be jumping in and out of your trades, okay? You want to own put positions. That's the greatest asset that you could own right now, given the current market conditions, given the fact that we're in a 17-year bull market with the market being up 50% in the last 6 months, and considering that the market has ignored all the economic conditions that pertain to 90% of the businesses, and it decided to focus on only on what 10% of the businesses are doing, okay, you're about to see the greatest market repricing in the history of the markets. And yes, I'm going to say this, that October 19th, 1987, the size of the drop then could actually be exceeded on October 19th, Sunday night, futures trading, going into October 20th, 2025, guys. If you want to max out your account to the moon, get in touch with a 13 Market Moves coach. Remember, 1973, 1987, 2007, 2008. That's what the charts are telling us, and that's what the behavioral patterns are telling us. 13 Market Moves sequence has never been this fucking bearish. Make it big. Grab your balls and make it fucking big.